IFRS Sustainability Disclosure Standards, particularly IFRS S1 General Requirements for Disclosure of Sustainability-Related Financial Information and IFRS S2 Climate-Related Disclosures, were developed by the International Sustainability Standards Board, ISSB, to improve consistency, comparability, and transparency in sustainability reporting. These standards respond to increasing global demand from investors, regulators, and stakeholders for reliable information regarding environmental, social, and governance (ESG) risks and opportunities affecting enterprise value. IFRS S1 establishes the general framework for sustainability-related disclosures, while IFRS S2 focuses specifically on climate-related risks and opportunities. Together, these standards aim to integrate sustainability information with traditional financial reporting, enabling stakeholders to assess how sustainability issues influence an entity's strategy, financial performance, risk exposure, and long-term resilience. The scope of IFRS S1 covers sustainability-related risks and opportunities that could reasonably affect an entity's cash flows, access to finance, or cost of capital over the short, medium, or long term. The standard requires entities to disclose information material to investors and other primary users of financial reports. IFRS S1 establishes general disclosure requirements relating to governance, strategy, risk management, and metrics and targets associated with sustainability issues. Its objective is to provide a comprehensive baseline for sustainability reporting that complements IFRS accounting standards. By creating a globally consistent disclosure framework, IFRS S1 enhances comparability across industries and jurisdictions while helping organizations communicate how sustainability considerations influence enterprise value and future economic performance. IFRS S2 specifically addresses climate-related disclosures and builds upon recommendations developed by the Task Force on Climate-Related Financial Disclosures, TCFD. The standard requires entities to disclose information regarding climate-related physical risks, transition risks, opportunities, governance processes, strategic responses, and financial effects associated with climate change. Physical risks include extreme weather events, rising sea levels, and changing environmental conditions, while transition risks involve regulatory changes, technological developments, and shifts toward low-carbon economies. IFRS S2 also requires disclosure of greenhouse gas emissions, climate targets, and progress toward sustainability objectives. These disclosures provide stakeholders with insight into how climate-related issues may affect financial performance, operational resilience, and long-term organizational sustainability. The core content of IFRS S1 and S2 is organized around four interconnected pillars: governance, strategy, risk management, and metrics and targets. Governance disclosures explain how boards and management oversee sustainability and climate-related matters. Strategy disclosures describe the actual and potential effects of sustainability-related risks and opportunities on business models, operations, and financial planning. Risk management disclosures explain processes used to identify, assess, prioritize, and manage sustainability-related risks. Metrics and targets provide quantitative and qualitative performance indicators used to monitor sustainability objectives. This structured framework ensures consistency and enables users to evaluate how sustainability considerations are integrated into organizational decision-making, operational planning, and long-term value creation within evolving economic and environmental conditions. Climate-related disclosures are increasingly useful because climate change presents significant financial, operational, regulatory, and reputational risks for organizations across industries. Investors and stakeholders require transparent information regarding how entities manage climate risks and capitalize on sustainability opportunities. Disclosure of climate-related risks helps users assess potential impacts on revenue generation, supply chains, asset valuations, insurance costs, financing access, and long-term profitability. Climate-related opportunities, such as renewable energy investments, low-carbon technologies, and sustainable product innovation, may also create competitive advantages and new growth prospects. By disclosing these factors, entities improve stakeholder understanding of future resilience, adaptability, and strategic preparedness in response to changing environmental and regulatory conditions affecting global markets and economies. The usefulness of IFRS S2 disclosures also extends to capital allocation and investment decision-making. Investors increasingly integrate sustainability and climate considerations into valuation models, risk assessments, and portfolio management strategies. Standardized climate-related disclosures improve comparability between entities and reduce information asymmetry, enabling investors to identify organizations better prepared for climate-related challenges and opportunities. Financial institutions, regulators, and credit rating agencies also rely on sustainability disclosures when assessing lending risks, financing conditions, and long-term economic stability. Transparent climate reporting therefore supports more efficient capital markets and encourages organizations to strengthen governance, risk management, and strategic planning related to sustainability. This contributes to broader global efforts promoting sustainable economic development and responsible corporate behavior. Overall, IFRS S1 and IFRS S2 represent a significant development in global corporate reporting by integrating sustainability and climate-related information into mainstream financial disclosure frameworks. These standards provide a structured, internationally consistent approach for communicating sustainability-related risks, opportunities, governance processes, and performance metrics. By enhancing transparency and comparability, the standards support informed decision-making by investors, regulators, lenders, and other stakeholders. Climate-related disclosures are particularly valuable because they help assess organizational resilience, strategic adaptability, and long-term value creation within increasingly uncertain environmental and regulatory conditions.